Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, Iran's Strait of Hormuz shutdown halts 20% of global oil, creating a stagflation dilemma for the Fed and ECB. We'll analyse why this supply shock matters now and how it complicates the global fight against inflation and threatens market stability. Second, gym earnings split. Affluent consumers power lifetime's growth while Planet Fitness struggles, signalling a spending ceiling for the mass market. In this episode, we'll break down this consumer divergence and what it signals for the Federal Reserve and consumer discretionary stocks. Third, Trump administration blacklists Anthropic as the AI firm scraps its safety pledge, igniting a civil war over US AI regulation. We'll explore how this battle between market pressure and safety concerns could reshape the future of US tech competitiveness against China. Major oil and gas companies have suspended all shipments through the Strait of Hormuz. This is not a drill or a future threat. This is happening right now. The shutdown comes after US and Israeli attacks on Iran and Tehran's subsequent declaration that it has closed navigation in the world's most critical oil choke point. A while back, we talked about how tensions were inflating a geopolitical risk premium on oil. Today, that abstract premium has become a real-world halt in flows. The Strait of Hormuz is what economists call a choke point. It's a narrow passage with no practical alternative, and when it closes, it triggers a severe supply shock. This isn't just about oil getting more expensive. It's a fundamental threat to the global economy's stability. As we noted before, the economic damage usually starts even before any closure, and with navigation now declared shut, the shock we worried about is here. Now, get this. 20% of the entire world's oil supply flows through this single strait. That's 1/5 of global oil from producers like Saudi Arabia, the UAE, and Iraq, now cut off. It also includes massive volumes of liquefied natural gas from Qatar. Today's freeze is that vulnerability we flagged made concrete. To put that in perspective, for Europe, this disruption represents a new energy security crisis. After cutting off Russian gas, Europe turned to Qatar for about 14% of its LNG. For China, the world's largest crude oil importer, the situation is even more acute. Nearly 1/3 of all its oil imports pass through the strait. A sustained closure could force an immediate reliance on strategic reserves, potentially slowing its economy. Satellite images from tanker trackers confirm the paralysis. Vessels are piling up near major ports like Fujairah, not moving. A top executive at a major trading desk minced no words, stating, "Our ships will stay put for several days." This is no longer about pricier war risk cover. It's about immobility. The source of the chaos is a direct order. An official with an EU naval mission confirms that Iran's Revolutionary Guards are broadcasting to all ships. No ship is allowed to pass the Strait of Hormuz. We previously discussed Iran's threats as a bargaining lever. This time, the lever is being pulled. So the thing is, this creates a stagflationary environment. A jump in oil prices acts like a massive tax on global consumers, slowing down economic growth while pushing inflation higher. This combination derails the soft landing narrative and creates a terrible dilemma for central banks who might have to choose between fighting inflation and causing a recession. But that's not the whole picture. The UK Navy has advised vessels that Iran's orders are not legally binding. The United States Navy, however, has issued a far more chilling warning. It has advised against navigation in the entire region, stating it could not guarantee the safety of shipping. And here's a crucial detail. The world's primary defense against a shock like this, the strategic petroleum reserves, may not be as effective this time. The US reserves are at historically low levels after major releases in recent years. A less potent SPR response means market prices could be more volatile and stay higher for longer. At least 14 LNG tankers are already showing signs of stopping or turning back. With a vital artery for global energy effectively blockaded, the market has entered a period of extreme volatility. So, where do we go from here? The focal points to watch are clear. First, listen closely to communications from central banks like the US, Federal Reserve, and the ECB. Second, watch the weekly US oil inventory reports to see if strategic reserves are used. Finally, keep an eye on European natural gas futures, which will be a key indicator of how severe the energy crisis in Europe is becoming. We were just talking about a massive global shock creating stagflationary pressures. Now, let's zoom in to see how those pressures are already playing out in the US, revealing a deep split in the economy that's showing up in an unlikely place. The gym, We're seeing two of America's largest gym chains report strong growth, but their earnings reveal a fascinating duality. On one side, you have the luxury fitness club, Lifetime. They hiked membership dues by as much as $30, and demand didn't slow down at all. In fact, in-center spending topped $191 million in the fourth quarter. Average revenue per member skyrocketed nearly 11%. Their CEO calls it a super engaged membership model, proving their high-income customers are unfazed by rising costs. This is a perfect textbook example of what economists call the wellness premium. The data shows that after the pandemic, affluent consumers are eager to pay more for premium health experiences. Lifetime's recent financials prove it. For 2025, their total revenue jumped over 14%, but their net income surged by an incredible 139%. Their pricing power is immense. You know, their average monthly membership is now approaching $190, a clear signal that their target demographic remains financially strong. But then there's the story from the budget-friendly giant Planet Fitness. Despite adding 1.1 million members, the company delivered a disappointing outlook for 2026. They experienced a higher cancel rate than anticipated, raising serious concerns about demand from their price-sensitive customer base. This brings us to a concept called price elasticity of demand, which measures how much demand changes when a price changes. For Planet Fitness, demand is highly elastic. This is a symptom of a much bigger issue. Operating margins for the entire consumer discretionary sector fell nearly 10% year over year, suggesting financial strain on the lower income consumer is becoming a major problem for all mass market businesses. This is where the situation takes a more complex turn. Analysts are now openly questioning the company's future. One from Stifel declared that Planet Fitness now faces a credibility hurdle, asking if its targets are simply unrealistic. The weakness at Planet Fitness could be a canary in the coal mine, a leading indicator that the lower income consumer is finally hitting a spending ceiling. While credit card delinquencies have stabilized for now, any increase in financial stress could ripple through the economy, potentially altering the Fed's policy decisions. This isn't just about gyms. It's a clear signal of a K-shaped economy. The results from Lifetime show affluent households are still spending freely, while the weakness at Planet Fitness suggests millions of others are being squeezed hard. The fitness industry just provided a real-time stress test of the American consumer, and the results show the market is sharply breaking in two. So for investors, the takeaway is pretty stark. Companies catering to high-income consumers may continue to show strong revenues. Conversely, mass market stocks like Planet Fitness could face continued pressure. The key focal point now will be broader consumer credit data and retail sales reports to see if this weakness is spreading. Speaking of markets breaking in two, a civil war is erupting in the tech industry, and it could determine the future of AI in America. The Trump administration just blacklisted AI startup Anthropic after it refused to comply with the Pentagon's demands, all while the company scrapped its own core safety pledge. The flashpoint was a specific demand from the Pentagon for unrestricted access to Anthropic's AI for all lawful purposes, which could include mass surveillance or autonomous weapons. Anthropic refused, citing ethical concerns, and was promptly designated a supply chain risk. Interestingly enough, a powerful market dynamic is at play, something researchers call the AI safety discount. It seems capital markets are rewarding AI firms that prioritize rapid, unregulated development with high valuations. This creates a powerful incentive for a race to the bottom on safety. As we discussed a while back, policy moves that raise the cost of building AI infrastructure in the US compound this pressure, pushing companies to shed guardrails just to keep pace. Anthropic claims its hand was forced by competitors racing ahead, with researchers at both Anthropic and rival OpenAI resigning in recent weeks, warning of the risks. This isn't just corporate drama, it's a symptom of a massive technological shift. According to NVIDIA CEO Jensen Huang, AI just went through its third inflection, evolving from simple chatbots to agentic systems that can reason and actually do work. And this is a fundamental change because agentic AI is different. It can perform complex, multi-step tasks on its own, tasks traditionally done by human professionals. As we flagged earlier, these more capable agents aren't just a software story, they're an energy story. More autonomy means more compute, which means more power. The market is reeling. This advance from chatbot to executive assistant has triggered an indiscriminate sell-off across software, legal, insurance, and cybersecurity stocks. Now, this sell-off isn't just a temporary dip. It's likely a leading indicator of a permanent structural deflationary shock for white-collar service industries. It signals a deep repricing of entire sectors, challenging the idea that AI lifts all boats. The economic gains may end up highly concentrated with a few foundational AI platform owners, but the real battle is just beginning, and it's moving from Silicon Valley to Washington. In a New York congressional race, State Assemblyman Alex Borres, who authored the first major AI safety law in the country, is now a target. A massive $125 million super PAC, backed by major tech figures, has been formed to oppose him. These local elections are becoming a proxy battle for the soul of the AI industry. The outcome will help determine whether the US adopts a strict, rules-based approach or a more hands-off model, which will dictate innovation speed for the entire sector. Bors himself put it bluntly, stating, "They've made clear they want to make an example here that if they win this race, they're going to go to every member of Congress and say, 'Don't you dare regulate AI, otherwise we'll spend $10 million against you.'" And the timing is critical. This internal civil war in the US over AI safety could have global consequences. While the US is caught in this policy deadlock, it risks widening China's competitive lead, especially considering China's significant energy cost advantages for data centers. The fight over the future of artificial intelligence is escalating, with billions of dollars on the line. As Boys warns, this is moving very, very quickly. We are running out of time.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.